Welcome back, folks, to CIOs and Bow Ties. Your CIO, Greg Silverman, here. On the line, we have Adam Cohen, Restructuring and Turnaround expert, been in the transportation logistics industry. I know has had a lot of experience in the restaurant franchising business. You know, Adam, what strikes me about your business is I'm imagining as a turnaround expert, or not, putting something out to pasture, as it were. There's a lot of emotion involved as you're dealing with various stakeholders, creditors, and owners. How do you deal with that? How do you deal with the pressure personally, and how do you interact with the various stakeholders?
It's a great question. It's tough, and I kind of equate it to being like an oncologist. You come in. Sometimes you're an oncologist, and sometimes you're an undertaker. But the oncologist is the one we like to focus on, because they're the ones that actually try to save the patient. In many ways, we come in and we've seen this in 3 different cases yesterday, and 2 the week before, and 4 the week before that. So it's fairly unemotional for us. It's just matter of fact where you stand, and then you have to remind yourself about the bedside manner and dealing with owners and lenders that really have a lot on riding on the outcome of the business. And then to continue with the oncologist metaphor, you're talking about what stage of cancer you have, right? We're gonna try to give you the best outcome possible, but we all have to be on the same page as where we're starting off, and sometimes that can be hard to deal with. You've got $30 million of debt, and your company's worth $5, versus you have $30 million of debt, and your company's worth $28. We can get you back up to 30. There's a big difference, and sometimes what your company's worth and where it can go is where we encounter some of the emotion that we've got to work through. What my approach is to usually start with the numbers, and from getting the input from the client, and putting together the pro forma of what they can do in their most optimistic view, then come back and say, what would somebody else discount on that, and what would somebody else pay for that? And now let's compare that to, let's compare that to what you owe everybody else. Is that viable? And what can we do to improve that?
Okay, so fairly unemotional. Well, good, better you than me, but the investment business is one where you got to put your emotions aside. So listen, I was recently reading that I think it was like 2/3 of credit portfolio managers expect corporate defaults to increase globally over the next 12 months, and that was a quote by the International Association of Credit Portfolio Managers. What you've really sketched out for me so far is an element of kind of micro or industry-specific stress at the moment. We haven't spoken about oil and gas, and I know from personal experience there is a fair bit of stress and distress going on there. And then you've mentioned some isolated, not even industries, but isolated situations. What our listeners are really, I wouldn't say hoping for, no one's hoping for it, but what we're probably anticipating is something a bit more of a broad macro credit event. And, I consider, is this really an interest rate event, or is it a credit event? And I think the two are really coinciding in the sense that, interest rates are really low. If they were to rise, it would probably slow the general economy even further. So any advice on for our listeners and for investors in general, how to play a big distress cycle coming, let's say coming down the pike?
Yeah, I mean, generally speaking, despite, the defaults that we're seeing and some of the, distressed sales that we're seeing, we're still in a situation where, we're finding, buyers are still paying fairly good prices for these businesses. And, my general thought is that all of these things correct, and more often than not, they initially overcorrect. So, if you're looking to invest, my thought is, hang tight. As these defaults grow, we're likely going to find that people are shying away, that the amount of lending is going to overcorrect or overcontract. And at the same time, we're not going to have enough buyers to, take these distressed deals over. And so that's going to impact pricing, a lot. And so looking for deals, I think, if you're a lender, be prepared to lend to the right operators that are going to go get a steal on a really good company. If you're private equity, then wait and try to buy these companies. And if you have some extra dry powder and can, make all cash deals and refinance later after you complete the turnaround, that's even better as well.
Mm-hmm. Okay, so hang tight, folks, is kind of Adam's message here. You're called in, at various stages of the credit cycle. If folks wanted to get hold of you, wanted to ask you questions, I know a lot of our listeners are sitting on, large amounts of private credit, and I suspect some of them are seeing some credit issues popping up here and there. Some of them may not be, directly involved with the portfolio companies themselves, but they're involved through a fund or a co-investment situation. How best to engage you, and at what stage is it best to engage you, Adam, and your company?
Well, I mean, we always think that the outcome is better. The earlier that you get in, you've got more runway. You can sometimes, spend your way out of it. You can sometimes, make some operational moves, before you hit the wall. So even if it's an initial phone call, some quick free advice, we're happy to get involved. And if it's one of those places where we don't see where we can help, then we tell you that too. But we've never found a time where you just say, man, if you had only waited longer, things would have gotten better. It doesn't seem to
strategy, right?
Go like that.
Close your eyes and
right.
Yeah.
Once you're smelling a problem, it's there.
Yeah, indeed. All right, folks. Well, listen, we've been, I'll just be, honest about this one. We've missed the mark on this. We've been building our distressed debt war chest for some time, and frankly, this distress cycle has not emerged. I suspect ultra low interest rates and some kind of money pumping liquidity into the system is keeping us afloat. But the old saying that trees don't grow to the sky. So listen, Adam, thank you so much for joining us today. It's very educational, and I know a lot of your work is kind of in the details. And so I just want to thank you. We'll put up your contact details here. If anybody has a portfolio issue or has a direct issue with any credit situation or just overall business situation, specifically, I would say in the franchise space, but no matter the industry, I think Adam's a good guy that you should be speaking to. So Adam, any final words from you, and thanks for joining us today.
Well, thank you.